Hi, Matthew Carr, Chief Trend Strategist for the Oxford Club. Welcome to this episode of Market Trends. This week, we're going to talk about a mass extinction event that I see on the horizon, and that there are hundreds of companies that I believe investors need to be selling or outright avoiding right now. It was triggered by the historic 300% one-day drop in the price of crude. Now, to say that that was the most catastrophic day in oil's history kind of feels like an understatement because there's nothing even that remotely compares to it. You know, prices fell more than 300%. We're in the negative territory for the first time ever. But this is an environment that I've been trying to prepare investors for the last couple of years. In fact, to start off 2020, I forecast that the price of crude would fall more than 50% to under 40. And that was even before COVID-19. It's not that I was psychic. It was just that the market was already oversupplied, as it has been for the past several years. And that has weighed on energy shares. In fact, over the past 5 years, the energy sector has underperformed the S&P 500 and the Dow Jones Industrial Average by an exceptionally wide margin. And it's not going to get better anytime soon, because COVID-19 brought the U.S. economy to a screeching halt. There are no buses shuttling people. Flights are grounded. Cars are collecting dust in garages. People are working remotely. And on top of that, we have tens of millions of Americans that are just unemployed, that don't have jobs. All of this is just adding to the glut that we already had in place. Now, the United States is the largest oil producer in the world. In March, we were producing, averaging about 13.1 million barrels per day. That's huge. But at the same time, what we have is this foreign oil that's being shipped to our shores in sort of like record amounts. So in February, the U.S. was importing 366,000 barrels per day of Saudi crude. By March, that had doubled. And in April, that had quadrupled to 1.46 million barrels per day. All of this oil is flooding into the United States at a time where demand is essentially zero. This means that it has nowhere to go, and it's just collecting in storage. And right now, U.S. storage is 6% above its 5-year average. We're tapped out, and this is just completely weighing on crude prices. This is a sort of cataclysmic event for the entire industry. Because if we think back to 2014 to 2016 and the damage that was done then, this is going to be several magnitudes of that. During that time, 2014 to 2016, the price of crude fell from over $100 to $26 by February 2016. That 70% drop was one of the largest declines in oil's history since World War II. And on top of that, this triggered a massive amount of destruction. Since 2015, 200 drillers have filed for bankruptcy. In 2019, 32 drillers filed for bankruptcy, and that was when oil was averaging around $50 per barrel. So the current environment is just going to be something that borders on apocalyptic. Projections are, if oil stays around $20, you will see 533 companies file for bankruptcy by 2021. If it falls to around $10 per barrel, the number of bankruptcies more than doubles to over 1,000. So I know this is a period of time where a lot of investors are thinking, gosh, oil prices are so low, they're at the lowest levels they've ever been. It's time to go dumpster diving. Well, I'm here to tell you that you're not going to find value. More often than not, you're going to find yourself in the middle of another dumpster fire than anything else. This is going to be a pretty traumatic time going forward because of all of this oil that's just, flooding the United States. And we already know Whiting Petroleum has already filed for Chapter 11. We know Occidental has paid its quarterly dividend to Berkshire Hathaway in a form of shares instead of cash because they just don't have it. So this is a very dangerous environment and investors need to be careful. First and foremost, avoid all oilfield services companies. I'm talking Halliburton, Schlumberger, Baker Hughes, which is owned by GE. All of those companies are going to be in a lot of trouble because production in the U.S. needs to basically come to a halt to let all that oil that's in storage be sucked up when demand eventually returns. That means all those oilfield services companies, they have no business. Second, oil is a pretty capital-intensive industry. So a lot of companies can get overextended and over-leveraged really quick, especially when prices are tanking like they are right now. So the companies that I avoid are companies that have debt-to-equity ratios above 100%, as well as debt-to-EBITDA ratios of 4% or more. I'm talking Laredo Petroleum, Seadrill, NewStar. All of those companies face serious headwinds. On top of the fact that not only is there the lurking bankruptcy possibility in the future, but then there are delisting issues as their share prices continue to fall, and they fall under the $1 requirement that the NYSE and the NASDAQ both have. So this is an historic moment for the U.S. oil industry, one that many companies just simply won't survive. But investors can protect their portfolios by avoiding those companies that I've just outlined here, oilfield services, as well as those that are over-leveraged, or they can even book gains by buying puts or selling short those very same companies. But the fact is, this is a falling knife you don't want to try to catch. Investors are going to get hurt, and if they're not careful, they can get hurt very seriously. So I'm Matthew Carr, Chief Trend Strategist for the Oxford Club. Thank you for watching this episode of Market Trends. For more information like this, be sure to subscribe, as well as go down to the description and sign up for my free e-letter. Until next time, here's to high returns.